Hi, this is that part of the second lesson, that is the ledger and the concept of double entry. Now we are still going to look at this question. So in this part, we shall post these transactions in the ledger, then balance off these ledgers, and then at the end, we prepare the trial balance. So remember in the second part, we did the journal. So here we are going to do the ledger. So the question is, Ahmad's financial position as at 1st August 2014 was as follows: cash in hand 26,300, cash at bank 24,000, and stock 3,600. So these are the only items that the business had at the beginning of that period. So what you have here are assets only. When you have cash, bank, and stock, those are assets only. So there were no liabilities at the beginning, and then we haven't been given capital. So for us to obtain capital, we'll have to use the balance sheet equation to know what capital is. And you remember the balance sheet equation is asset is equal to capital plus liabilities. We have our assets here. We don't have liabilities. So but we need to have capital. Every business has capital. Capital has to be there, but liabilities need not to be there. Liabilities must not need not to be there. Assets have to be there, and capital has to be there. So if we don't have liabilities, then assets is simply capital. Yeah, so like, as you can see in the balance sheet equation, when the assets are there and the capital is there and the liability is zero, asset is simply equal to capital. So in our case here, you have three assets, that is cash in hand, cash at bank, and stock. The amounts are 6,300, 24,000, and 3,600 respectively. So adding them together, that is cash in hand 6,300, cash at the bank 24,000, and stock 3,600. The total of those three items will give us 33,900. So please pardon me, when I was doing the journal, I made a mistake under cash at bank. So I took cash at bank to be 2,400 instead of 2,400. So where that mistake costed us because we got finally the wrong figure for capital. So please, hope you were able to see that mistake and you understood, and yeah, you got to know where the mistake was in. But in this case, I've corrected it. The cash at bank is 24,000, not 2,400. So therefore, the total asset is 33,900. And being that there are no liabilities, where capital is equal to assets minus liabilities, and assets in total we've seen is 33,900, then minus zero liabilities, we get our capital to be 33,900. So at the beginning of that particular period for Ahmad's business, the capital was 33,900, and the total for the assets that the business had was 33,900. So next, we are supposed to post these transactions in the ledger. Supposed to post these transactions in the ledger, but before you do that, these opening balances must also be in the ledger. These opening balances that we have for cash in hand, cash at bank, and stock need to be in the ledger. So we do that. We open the accounts for cash in hand and cash at bank. So cash account. So you do a T account for it. For cash account, so you draw a T account for cash at bank. So cash is an asset, and assets will always have a debit balance. So at the beginning of the period, the debit balance will appear on the debit side of the account. So therefore, it will be on August 1st. August 1st, we have balance brought down. So in this case, it's a brought down. So brought down is usually at the beginning. So which is cash in hand 6,300. So this now is a debit balance. Cash being an asset will always have a debit balance. Assets will always have a debit balance. And at the beginning, the debit balance in an assets account or the debit balance in any account should be on the debit side of the account. Whereas at the close, the debit balance of an account should be on the credit side. So hope you you are going to get that. Then we open the other account for cash at bank. So that is bank account. The bank account. The bank account also had some money. So open an account on the bank. So bank, unless told otherwise, bank will always have a debit balance because it's an asset. So therefore, on August 1st, the bank had, that is balance carried down. The bank had how much? 24,000. 24,000 shillings. So that is a debit balance. So please note that. The other account is, okay, the other item we have is stock. Stock is usually not part of double entry. The value of stock at the end of the period is not determined by the double entry rules of debiting and crediting. Stock will never be there in the ledger. The way we value stock is through a physical stock taking activity, whereby a person goes to the store and counts every item in that store. So store is not a part of double entry. We don't have an account for stock. But say if we buy goods that go into the store, we record this in the purchases account. Yeah, we debit purchases account. And whenever we sell these goods, we take them out of the store, we credit them in the sales account. So there is nowhere whereby we shall be debiting and crediting stock. But the figure for stock that we get at the beginning and at the end of a particular period is determined through a stock taking. So whereby someone goes to the store and verifies by counting physically the amount of stock that is in the store. So therefore stock will not be there in the trial balance, in the ledger. So you shall not have an account for stock. The other item that we begin with is capital. So you need to have an opening balance for capital. So you open one capital account. So capital account. Open capital account. Capital will always have a credit balance, and at the beginning the credit balance will always be on the credit side. So we have it here, August 1st, by capital, and the amount is, we found the amount of capital to be 3,300 when we are using the balance sheet equation. So that 3,900 is our capital. So and then we move now downwards the transactions. So we post these transactions in the ledger. So the first transaction on August 2nd, purchased goods in cash 4,000 shillings. Purchased goods in cash 4,000 shillings. Here, the two accounts being affected is cash account and purchases account. So you already have the cash account. We do not have the purchases account as yet. So we open a purchases account. We open purchases account. We open purchases account. Now, what type of accounts are they? Cash is an asset and purchases is an expense. Cash is decreasing, so therefore we credit cash because it's going down. And then purchases, being is an expense that is being incurred, we are supposed to debit purchases. So whenever expenses are increasing, we're supposed to debit. And whenever cash assets are decreasing, we're supposed to credit. So therefore, credit cash, debit expenses. So credit cash, that is on August 2nd. We credit cash, that is by purchases, and the amount is 4,000. And then debit purchases. So August 2nd, debit purchases by cash, and the amount is 4,000 shillings. Then move on to the second transaction on August 5th. On August 5th, bought goods from Kamal on credit. So bought goods from Kamal on credit. In this case, with the business We bought goods from Kamal and we did not pay him. So therefore we have a credit in this case. So the two accounts here is purchases and Kamal's account. Yeah, being that now Kamal is our creditor. So purchases and Kamal. So what type of accounts are they? Purchases is an expense, Kamal is a creditor, and a creditor is a liability. So we have purchases an expense and Kamal a liability. So both are increasing. We are increasing in purchases, so therefore debit purchases, and the Kamal's account, which is a liability, is also increasing. So therefore credit Kamal's account. So you don't have Kamal's account as yet, so we open Kamal's account. Create Kamal's account and credit, since it's a liability. Credit Kamal's account since it is a liability. So that is on when? It's August 5th. August 5th. And this is by, we credit this by purchases. The amount is 17,500. 17,500. And then debit purchases account, made a mistake. This should come here. And then debit purchases, that is August 5th. August 5th, to debit purchases, the amount is 17,500. We move on to the third transaction, that is August 7th. In this case, both shop fittings by check, 2,400. The two accounts here is shop fittings and we have bank account. And the two accounts are all assets. So shop fittings are increasing, bank account is reducing. So therefore, debit shop fittings and credit bank account. So you don't have shop fittings account as yet, so we open one. So shop fittings account. So you open shop fittings account, since you don't have one as yet. Shop fittings account. So shop fittings are assets that are increasing, so therefore we debit shop fittings account. So that is August 7th. Debit shop fittings by the account is bank, since it was paid by check. The amount is 2,400. 2,400. And then credit bank account, because bank is going down. So August when? August 7th. Credit bank by shop fittings, and the amount is 2,400. Then we proceed to the other transaction, that is cash sales of 2,800 shillings. So sold goods and received cash. So the two accounts here is cash account and sales account. So we already have cash account, we don't have a sales account. But anyway, cash is an asset, sales is a revenue. So both are increasing. Cash is coming in and also earning more sales. So both are increasing. So cash being an asset, assets will always be debited whenever they increase. Sales being a revenue, revenues will always be credited whenever they increase. So in this case, therefore, we debit cash and we credit sales. So we open a sales account. We open sales account. We open sales account. And credit, being that this is a revenue that is increasing. So credit sales, that is on 11th of August. August 11th, we credit sales by cash. And the amount is 2,800. 2,800. And then we debit cash on August 11th. This is by sales, and the amount is 2,800. 2,800 shillings. We proceed to the other transaction. Sold goods to Kasimu on credit. So in this case, the two accounts is sales and the other account is Kasimu. Because it's sold to Kasimu on credit, no cash or bank has been received. So in this case, we end up with a debtor, who is an asset to the business. So the two accounts therefore are sales and Kasimu. Sales is a revenue and Kasimu is a debtor, which is an asset. So sales is a revenue and Kasimu is an asset. So both are increasing. So sales is, we are earning more sales, so therefore credit sales account, and therefore Kasimu's account, being that is an asset that is increasing, in that data we debit. So therefore credit sales and debit Kasimu's account. So we don't have Kasimu's account as yet, so we open one. So Kasimu's account. So we debit Kasimu's account because this is an asset. We debit Kasimu's account and credit sales account. So August 12th, 850. So credit cash sales account. So it's August. August when? August 12th, and the amount is 850. So credit sales by Kasimu. The amount is 850. The amount is 850. And then debit Kasimu's account on August 12th. The narration is by sales. The amount is 850. Then we proceed to the other transaction. August 15th, paid Kamal by check 10,000 shillings. So remember we had goods that you had purchased from Kamal on credit, and Kamal is our creditor, a liability as yet. So you already have Kamal's account. So the two accounts here, paid Kamal by check, is bank account and Kamal account. So both are decreasing. Bank is an asset, Kamal is a liability. So therefore, we credit bank with a decrease, with a going down, and then we debit Kamal's account because it's also reducing. The liability we have in Kamal is also reducing. So therefore, we debit Kamal's account. So therefore, credit bank, debit Kamal's account. So that is on August 12th. Credit bank by Kamal, and the amount is 10,000, and then debit Kamal's account by bank. That is on 12th of August. August 12th. Credit Kamal by bank, and the amount is 10,000 shillings. Then we proceed. 18th, cash sales. So for cash sales, the two accounts here is cash and sales. Cash is an asset, sales is a revenue. Both are increasing. Cash is coming in and we are earning more sales. So cash being an asset, it's increasing. We're supposed to debit cash, and sales being a revenue, it's also increasing. So you're supposed to credit sales account. So therefore, debit cash, credit sales. So that is on August 18th. Debit cash by sales, and the amount is 4,700. Sorry, it's 4,700. And then credit sales by cash 4,700. That is on August 18th. August 18th. Credit sales by cash, and the amount is credit sales by cash. The amount is 4,700. 4,700. We proceed. 19th, paid cash into bank. So in this case, the two accounts is cash account and bank account. So he took cash from his office, from the business, and deposited this cash into the bank. So the two accounts is cash and bank. They are all assets. Cash will be reducing and bank will be going up. So therefore, we credit cash and debit bank. So credit cash and debit bank, we have the two accounts with us here. So that is August 19th. Credit cash by bank, and the amount is 800, and then debit bank on August 19th. The narration is by cash and the amount is 800. We proceed. On April 20th, Ahmad withdrew goods for his personal use. So the two accounts here is drawings and purchases. Drawings and purchases. So drawings is a deduction in capital, purchases is an expense. So drawings being a deduction in capital is supposed to debit. So therefore, you're supposed to debit drawings, and then purchases being that purchases is an expense, and this expense is going down, we're supposed to credit purchases. So therefore, you debit drawings and credit purchases. So you open a drawings account since you don't have one as yet. Open drawings account and debit. Drawings account with debit. And when is it? On 20th. On 20th of April, August, sorry, 20th of August, with due purchase from purchases. And the amount withdrawn was how much? 300. So debit drawings by purchases 300, and then credit purchases account by drawings 300. That was on 20th. So August 20th. Credit purchases by drawings, and the amount is 300 shillings. We proceed to the other transaction. 20th, paid carriage in cash. Carriage is a transport expense, so carriage is an expense. So the two accounts here is carriage and cash. So carriage is an expense, cash is an asset. So we are incurring more expenses. Whenever an expense is going up, we're supposed to debit. So therefore, debit carriage account, and then cash account will be going down. It will be decreasing to go and pay for the carriage. So therefore, we credit cash account. So you don't have a carriage account as yet. So you open one. So carriage account. So you debit carriage account. Debit carriage account. That is on 20th August 20th. Debit carriage, this is by cash, and the amount is 200 shillings. By cash, the amount is 200 shillings. Then we credit cash. Cash is up here. So that is August 20th. We credit cash by carriage, and the amount is 200 shillings. Amount is 200 shillings. Then we proceed. 23rd, bought goods from Mantau in cash. Bought goods from Mantau in cash. So the two accounts here is cash account and purchases. Cash and purchases. So in this case, we will not have any Mantau's account because alitulipa na tukamalizana. So you need no account for Mantau. So as such, the two accounts here is purchases and cash. And you have both accounts. So cash purchases is an expense, cash is an asset. The expense is going up, so therefore we debit purchases account, and cash is decreasing, so therefore we credit cash account. So we do that. So August 23rd, we credit cash by purchases. We credit cash by purchases on August 23rd. The amount is 640. And then we debit purchases by cash. That is on August 23rd. August 23rd, debit purchases by cash The amount is 640. And see, I forgot to put a description on 5th in the purchase account. What should have been description? B. On 5th, 17,500, bought goods from Kamal on credit. So this should have been Kamal. 17,500. Then we proceed. On 27th, sold goods to Kenneth on credit. The two accounts here is sales and Kenneth. Yeah, so we've sold to Kenneth on credit basis. He hasn't paid us, so we need an account for him. So therefore, the two accounts here is sales account and Kenneth. So sales is a revenue. Kenneth owes us money. He's a debtor, and that's an asset. So sales is a revenue. Kenneth is an asset. So both are increasing. So sales, we're earning more sales, and we're having an increase in an asset. So sales revenue, whenever it's increasing, is opposed to credit. So therefore, credit sales account, and then Kenneth's account we debit because it's an asset that is increasing. So we don't have a Kenneth's account as yet, so we open Kenneth. So you open Kenneth's account and debit. So Kenneth is an asset, so we debit. So that is on when? 27th, August 27th. We debit this by sales, and the amount is 1,300. And then credit sales by Kenneth. That is on 27th August. The amount is on 27th August, and the amount is 1,300. 1,300. So credit sales by Kenneth, the amount is 1,300, and debit Kenneth's account by sales 1,300 shillings. Then we proceed to the other transaction. On 28th, bought a new bicycle and paid by check. So the two accounts here is bicycle and bank. Bicycle account and bank. They are both assets. So bank will be going down, so therefore we credit bank account, and the bicycle will be increasing, so therefore we debit bicycle. So credit bank, debit bicycle. So you don't have a bicycle account as yet, so you open one. So bicycle account. So you open a bicycle account and debit. So you shall debit the bicycle account. That is on August 28th. Debit bicycle account by bank, and the amount is 4,000. Then credit bank, then you credit bank by bicycle. That is on August 28th by bicycle, the bank account. Then we credit 4,000 shillings. Then we proceed on 31st of August, paid rent of premises by check. So the two accounts here is rent expense and bank account. The two accounts here is rent expense and bank account. Rent is an expense, bank is an asset. So rent is increasing, so therefore we debit the rent expense, because expenses, whenever they are incurred, we're supposed to debit the expense account. And then bank account will be declining, so we credit bank account. So you open a rent expense account. Open rent expense account. Open rent expense account and debit. So that is on August when? It's August 31st. This is by bank. We are paying by check. Yeah, a bank, and the amount is 2,500. And then we credit bank. Then we credit bank on August 31st by rent expense, and the amount is 2,500. Then we proceed further. On 31st of August, Ahmad withdrew cash for his personal use. So the two accounts here is cash account and drawings account. Drawings is a deduction in capital. Whenever capital is declining, we're supposed to debit. So therefore, debit drawings account, and then credit cash account because cash account is going down. So we have both accounts, so we'll enter that. We credit cash account on August 31st. Credit cash account by drawings, and the amount is 500. And then you debit drawings account, that is on August 31st by cash. The amount is 500. So now we've entered all the transactions in the ledger. The next step is to balance off the ledger, and then you prepare the trial balance. To balance off the ledger, we said is to insert the difference on one side of a ledger account so as to equate the debit and the credit totals of the account. So in most cases, you find that the two totals will not be equal, but will not be equal. Therefore, you need to add something on the lower side so that you have equal totals. So that something we add is a balance or the difference. And also say that there are three types of balances. We have the debit balance, the credit balance, and the zero balance. And we also said that assets and expenses, we always have a debit balance, whereas capital, liabilities, and revenues, we always have a credit balance. So let us balance off these accounts with straight what I've just said to insert the difference on one side of an account so as to equate the totals of the two accounts. So as you can see, we begin with our cash account. Cash account, the total on the debit side, is equal to 13,800, whereas the total on the credit side, the total on the credit side is equal to 6,140. So as you can see, the two totals are not equal. So we need to equate them. So to equate these totals, we add something on this credit side so as to make the totals equal. So in this case, we shall take the higher total and insert it here. So to insert it here, we insert, let's say on August 31st, we have the balance carried down. The balance carried down is one that we insert here to equate the two totals, and it shall be equal to 13,800 minus 6,140, which will bring us to 13,800. So now the balance that we have here is 7,660 for cash, and the totals are now equal. So this difference is a balance of cash account, and this is a debit balance. So debit balances, whenever you are closing the account, will appear on the credit side of the account. Yeah, so this is to show that the debit side is bigger than the credit side. So this is a debit balance, whereas the one that the opening balance is a debit balance, but they're appearing on the opposite sides. So please, I need to note that. Then we proceed. We balance off the bank account. So the totals of the bank account on the debit side is 24,800, whereas the total of the credit side is 18,900. So as you can see, the credit side is lower than the debit side. So therefore, we need to insert something on the credit side of the bank account. So therefore, on August 31st, by balance carried down, the difference now will be equal to 24,800 minus 18,900, which is equal to 5,900. So which equates the two totals. So this 5,900 is a balance of bank account, and this is a debit balance. So please note that. So the debit balance will usually appear on the credit side of the account. So this is a debit balance. Then we move forward to capital account. Capital account, the balance is simply, as you can see, 33,900. So that is on August 31st. The balance carried down for capital is 33,900. Yeah, I hope you can easily see that. So capital is as simple as that. Then you have purchases. Purchases, the total of the debit side is equal to, whereas the total of the credit side is equal to 300. So the credit side of purchase account is lower. So insert the balance on the credit side of purchases account. So balance carried down, which is equal to 22,140 minus 300. So purchases, the balance for purchases is 21,840, which is a debit balance. So I forgot to mention that capital account is a credit balance. Yeah, the one that we have here. And capital will always be a credit balance, whereas expenses will always be a debit balance. So therefore, purchases has a debit balance, which must always be a debit balance. Then we proceed downwards to Kamal's account. Kamal's account means we take the total of the two sides, the sum of, so the debit side of Kamal's account is 10,000, and the credit side of Kamal's account is 2,500. So the debit side is heavier than the credit side. So we insert the difference on the debit side to equate the two totals. So on August 31st, we have the balance carried down, which is equal to 17,500 minus 10,000, which equates the two totals. So therefore, the balance of Kamal's account is 7,500, which is a credit balance. So please note this. These are credit balance for Kamal's account, whereas for purchases account is a debit balance. So that is important for you to note. So shop fittings, the balance will be 2,400. So please, for the sake of time, I will leave that for you to complete. So the shop fittings is 2,400. For the sales account, the balance is 9,650. For Kamal's account, the balance will be 850. For drawings, the balance will be 800. For carriage, it will be 200. Kenneth, it's 1,300. 4,000 and 2,500. So I'm hoping that you've gotten the concept of balancing of accounts. So please, in your own free time, go and get the balances of the other accounts that are left. So next, let me look at the trial balance. Next, we look at the trial balance. So we have Ahmad's trial balance as at Ahmad's trial balance as at 31st August 2014. So you prepare this. So in this column we have the particulars. Here you have the debit balances, and then we have the credit balances. So then I draw the columns for this trial balance. So the trial balance is quite short. It needs not to be very long. Let me copy this to somewhere. Copy. Copy this here. So we say that the trial balance is a list of credit and debit balances extracted from the ledger is at a given date. The trial balance has two main uses: to help in checking arithmetic accuracy, to help us see whether everything, our accounting process has been okay. That is when the trial balance is at the end there. And also, the trial balance will help us in preparing the final accounts, which we shall cover in our next lesson. The final accounts, that is the balance sheet and the trading and the profit and loss account. So you prepare the trial balance in this case. So we have cash. The first account is cash, and the balance we found for cash was 7660, which is a debit balance. So we have it here. Then the other account we have is bank. The balance we have for bank we saw is 5900, which is a debit balance. So you have it here, 5900. Then the other account we have is capital. And capital is so it's a credit balance of 33900. So you have it, capital. You see it's a credit balance of 33,900. So on the credit side, 33,900. Then we have the other account is purchases. Purchases, you saw it's a debit balance of 21,840. So debit. So expenses will always have a debit balance. So purchases debit balance of 21,840. After purchases, the other account you have is Kamal's account. So Kamal and Kamal, the balance is so for Kamal is 7,500, which is a credit balance. Kamal is a credit balance of 7,500. So you have it there, credit. After Kamal, the other account you have is shop fittings, 2,400. Shop fittings, and it's shop fittings. Assets will always have a debit balance, and as you can see, is a debit balance. So shop fittings, 2,400. After shop fittings, the other account we have is sales account. Sales account. Sales account, the balance for sales account, I know I haven't balanced this thing off. I hope you've gotten the concept. You can do this in your own free time. But the sales account balance will be 9650, which will be a credit balance. 9650. Sales account is a credit balance of 9,650. We proceed downwards to Kasimu's account. Kasimu's account. Kasimu is what type of balance? This will be a debit balance of 850. Then after Kasimu's account, next we have drawings. It will be a debit of 800. So drawings, debit balance of 800. Then we have carriage, a debit of 200. Carriage, a debit of 200. And then we have, after carriage, the other one is Kenneth. It will be a debit of 1,300. Kenneth, a debit of 1,300. After Kenneth, we have bicycle, a debit of 4,000. Debit of 4,000. Then after that, we have the bicycle. The last one is rent expense, a debit of 2,500. Rent expense, a debit of 2,500. Then the last item before we forget is stock, the opening stock. It needs to be there in the trial balance, and the opening stock as we at the beginning was 3,600. The opening stock at the beginning was 3,600, and then you get the total, so the two sides. the sum of all these. So on the debit side, the total is 50, 990, and on the credit side is 51,050. A small problem there. I don't know where that has come from. What was the difference between the two? 51,050 minus 50,990. 60 bob. Why is the 60 bob disappearing into? Or cash. My cash, the cash balance supposed to be 7660. Cash balance is supposed to be 7660. So I had made a mistake there. So therefore, the total of the debit balances and the credit balances need to be equal in the trial balance, so as to ascertain whether our accounting process has been okay. And that is the second topic of introduction to accounting. That is the ledger and the concept of double entry. So thank you very much. Hopefully we shall meet and have a discussion on this topic. Thank you.